Welcome back to Freedom Finance with Lanny, guys. And tonight's Sunday night edition is all going to be about why you should not be holding any cash and what else you should be doing with it, guys. So grab your favorite beverage, your beer, your liquor, your wine, that espresso, get the coffee flowing, early AM, late PM, Monday morning, Monday night, no matter what. Check Freedom Finance here with Lanny, guys, and let's dive into what the heck is going on with the US dollar and why you shouldn't hold on to any of it. Let's get it. So this is going to be another quick video, guys, more on the conversational, educational topic here, the US dollar. This video is all going to be about the US dollar, and this is going to be really focused on everything outside, again, of that emergency cash savings, guys, because I don't want to hold any cash if I can help it outside of the emergency savings account and what I need for the checking account to pay the monthly bills, guys. You know, it's no question. Trillions of dollars have been printed over the last few years. And, you know, the deflationary concept of the dollar, or the purchasing power of the dollar continues to erode and get worse each year, aka inflation. What you get for a dollar today is, you know, terrible compared to what you could have done with your dollar 10, 20, 30, 50, 60, 70 years ago. And, you know, the reason for that primarily is the number of dollars out there in circulation and, you know, the consumer spend, right? The debt that is also being built on the balance sheets here in our country, guys. So that is, you know, decreasing the purchasing power of the dollar. And, you know, again, it really has hit home, especially the last few years. When you look at all asset classes, guys, you know, we could take real estate, right? The biggest purchase in most everyone's lifetime could be a house. And, you know, the price of a house back, you know, I was looking at data, you know, on maybe some Fed reports, some statistics reports from the government, guys. And I think it was the median sale price back in 1963 was $19,300 in real estate. Fast forward to the end of Q3 in 2024, the average sale price is $501,000. So that's an increase of $481,000 in about 61 years, if you're following and tracking with me, guys, or a 2,500% increase in 61 years. So the price of a house, the average median, whatever you want to call it, slice and dice it, give or take 40,000 in either direction, is about 2,500% higher since then. And then let's annualize that. What's the annual growth rate that real estate has actually gone through in 61 years? So you take that 2,500%, and I just divided it cleanly by 61 years, guys. That's about a 41% compounded annual return. Somebody check me on that, though. Just doing some quick high-level math here. So real estate has ballooned, you know, over the course of 61 years. So again, real estate's going up, or whichever way the screen is. You know, real estate's been just going up, right? A dollar is worth less when you buy real estate today, right? You know, considering I bought my house 13 years ago, it was under $100,000. Now it's definitely more than 2 times that right now in today's dollars. Ooh, yay, right? So just keep that in mind. Let's get into the stock market, though. We're investors here. I'm the big investor in the stock market. I'm buying VYM, VOO, VIG, buy plenty of individual stocks. I'm now at 61 individual stock positions, down from my low 70s to start the year. So I'm getting there, guys. Been a big investor in the stock market. 15 years of investing in the stock market, actually. And again, I was just looking at a Google Finance chart at the S&P 500 back in November of 1996. So only 28 years ago, the S&P 500 was at a whopping 748.7, below 1,000. And here we are, November, close on November 1st, and the S&P 500 is at $5,729. So why? What happened to the S&P? Well, the average market return is at least 10%. Well, the average in that time period is about 23% average compounded return here, because it's gone up about 665% in 28 years. Just using that small time frame, guys. Again, a 4,980 increase since November of 96. So what's gone? Oh yeah, money has flooded the economy. People put their money in the stock market. You probably have more buyers than sellers. Companies make way more money in 2024 than they do in 1996. So consumers, the dollars are just out there. The cost of everything is going up, right? The McDonald's $1 menu is no longer there. I used to be able to go there for $3 and get 3 things. Now you might be able to get 1 thing. Somebody can correct me on that. So just keep that in mind. The consumers haven't stopped going. There's just more dollars out there. So that's obviously flooded into the stock market, increasing those asset prices. So just keep following me. So remember, real estate over a 61-year period up 2,500%. Stock market in the 28-year period up 665%. Let's talk about gold. I was finding a chart on gold back in February, March of 1972, where the price per ounce was about $50. Let's fast forward to around about this time of this video. Gold is about $2,740 an ounce. So up about $2,690 an ounce in a, again, 52.5-year period. So that's a 5,400% change in that time period, compounded about 100% average return over that time period in gold. Freaking gold. I don't own specific gold. Do you own gold? I might have a gold chain from my late grandma, rest in peace, Nona. But let me know if you guys own gold. I'd be very curious on the investors out there. And somebody correct me again on these returns, but I'll show up all my data as I'm talking through them on the screen here. Time to get into the next asset class, guys. One that's a taboo sometimes in the stock market investors world here. Again, got to look at all asset classes because, again, this will really speak more true to cash. Let's talk about Bitcoin. We're going to talk about, yes, not cryptocurrency, but just Bitcoin in general here, guys. BTC or Bitcoin back in on May 6, 2016, according to Google Finance, about 8.5 years ago. We can all agree on that. Bitcoin was $453.99. Bitcoin now is just under $69,000 for one Bitcoin. So $68,543 increase in 8.5 years, or 15,000% change over that time period. Divide that by 8.5, 1,776% return on average. Somebody, again, has got to correct me there. If I just, again, take that percent divided by the number of years. So that's Bitcoin, right? Is that a good peg against the US dollar? I don't know, but I'll show up a chart here as well, if I haven't already, on the US dollar, on the purchasing power of what we see with the US dollar going from 50 years ago all the way today, showing what you can actually do now with $1. So guys, what's your point of holding cash outside of the emergency fund? So you can earn your 4% high yield savings, so you can get a 4% return, which is probably negative when you actually think about it. Or should you put it in stock market, real estate, gold, Bitcoin, other instruments? Shouldn't you be doing something else? Because we're only going to print more money, more than likely. And then when rates start cutting, consumers will start spending. And then you have to really look at what the Fed is doing on the Treasury side, guys. But I don't see how things will ever really go down long term outside of just the value and purchasing power of the dollar. So hopefully this hits you guys somewhere where you look at your checking account, your savings account, and you go, yeah, Laney's right. I need to invest everything that I can right now into all of these asset classes because on average, they all go up while the value of that checking account and that savings account goes down. So let me know in the comments what you guys think. What is your favorite asset class? Give me your top two, actually, because stock market probably is going to be a lot of number ones. Real estate might be a lot of number ones as well. So very curious on your two favorite asset classes that you move your cash out from and into, guys. Subscribe to this channel, guys. Like this video. Think about your cash. Think about these asset classes. And thanks for rocking with me. I will catch you on the next one.